You know, whenever inflation starts making the news, one asset always seems to pop up as the ultimate safe harbor: Bitcoin. And yeah, that whole digital gold story, it sounds great. But what if the real connection between something like an oil price shock, the inflation that follows, and Bitcoin is totally different from what we've all been told? Let's dig in and see what's actually going on. So, when you see it at the gas pump, you feel it at the grocery store, prices are definitely on the rise. And naturally, your first instinct is to find a way to protect your money, right? Well, for years, the crypto world has been saying, hey, we've got the answer: buy Bitcoin. But is that story actually holding up? And look, this wasn't just some fringe idea on Twitter. As you can see from this quote, major players like Bloomberg were pushing this exact narrative, especially during all the uncertainty of the pandemic. This idea that Bitcoin was the ultimate shield against a devaluing dollar, man, it gained huge traction. But as we're about to see, when you really start to look closer, that simple story starts to fall apart. Okay, so first things first, let's just quickly break down that popular theory. It's really easy to grasp, and honestly, on the surface, the logic seems pretty solid. The thinking basically goes like this. Oil prices shoot up, and that makes everything from gas to food more expensive. That's inflation, and it means the cash you have is suddenly worth less. So naturally, investors start looking for something scarce, something that can't just be printed into oblivion. And then there's Bitcoin, with its fixed supply of 21 million coins. It seems like the perfect digital safe haven, right? It's a really compelling story. There's just one tiny problem. The actual data tells a completely different one. All right, now this slide might look a little complicated, but the takeaway is incredibly simple. It's called a correlation heat map. Just think of it as a relationship tracker. If two things are bright red, they move together. They're best friends. If they're blue, they basically ignore each other. Now notice how the different types of oil are all deep red. They move in total lockstep. But then look at their relationship with Bitcoin, or BTC. It's deep blue. The value is pretty much zero. The data is practically screaming at us that there is no direct link here. So, if a jump in oil prices doesn't directly cause a jump in Bitcoin, what are we missing? Well, it turns out the connection isn't a straight line from the oil pump to your crypto wallet. No, it's more like a chain reaction, a hidden mechanism that works its way through the entire global financial system. So here's how it really goes down. Step 1, oil prices spike, and that pushes up costs for literally everything. Step 2, that triggers a rise in inflation. Now, step 3, this is the most important part. The Federal Reserve sees this and reacts by raising interest rates to cool things down. Step 4, those higher rates tighten up the money supply. It gets more expensive to borrow. And that leads directly to step 5, so-called risk assets. And yep, that includes Bitcoin. They tend to fall. So you see, the oil spike doesn't hit Bitcoin directly. It just kicks off a domino effect that does. And that whole chain reaction, that's exactly why all the data around Bitcoin and inflation can seem so confusing and contradictory. It's because Bitcoin isn't just following one simple playbook. It's actually following two. And which one it uses depends completely on what the central banks decide to do. Okay, so let's just stare this contradiction right in the face. On the one hand, you have serious research, like the study this quote is from, that finds Bitcoin does appreciate during inflation. It seems to confirm that whole digital gold story we talked about. But then you see this, a negative number. What in the world is that supposed to mean? Well, this number comes from a totally different study. And it found that when inflation numbers come in unexpectedly high, what they call an inflation surprise, Bitcoin's price actually falls by about 24 basis points, or 0.24%. So instead of acting like a shield, it actually gets dinged by the news. So, how can both of these things possibly be true? This slide right here is the answer. It all comes down to the policy regime. Think of it like this. On the left, in regime 1, you get inflation, but, and this is key, the central bank keeps policy loose. Money is cheap, it's flowing everywhere. In that world, Bitcoin is bullish, it soars. But then you have regime 2 on the right. You get the same inflation, but this time it forces the central bank to slam on the brakes and tighten policy with rate hikes. In that world, Bitcoin is bearish, it struggles. So you see, the key isn't the inflation itself, it's how the Fed reacts to it. So if digital gold isn't really the right label, then what is Bitcoin? Well, a much more accurate description is finally starting to emerge from all this data. And this quote, man, it just hits the nail on the head. We need to forget digital gold. Instead, we should think of Bitcoin as something more like a high-growth tech stock. An asset that absolutely thrives when money is cheap and investors are feeling bold. The fancy term for this is a high beta liquidity asset. But all that really means is that it's basically an amplifier for whatever's happening in the global economy. When the central banks turn on the money spigots and cash is easy, Bitcoin soaks all of it up and its price shoots for the moon. But when they're forced to turn those spigots off to fight inflation, making money tight, Bitcoin is one of the first assets to feel the drought. Okay, so what's the big takeaway from all of this? Why should you care? Well, understanding this hidden mechanism fundamentally changes how you should think about Bitcoin's place in the world. Let's just sum it all up. First, the link between oil prices and Bitcoin isn't direct. It runs straight through whatever the central bank decides to do. That means Bitcoin's performance as an inflation hedge is completely conditional. It depends. So the most important thing to watch isn't really the inflation number itself, but how the Federal Reserve is going to react to it. So maybe it's time we retire that digital gold nickname and start thinking of Bitcoin as more of a global liquidity sponge, soaking up cash when it's everywhere and drying out when it's scarce. And that really leaves us with one final, really powerful thought. The next time you see oil prices surging and you hear all the chatter about inflation, you'll know that the real question to ask isn't what's Bitcoin going to do, it's what is the Fed going to do? Because at the end of the day, their reaction is what will truly decide what happens next.